Welcome to the CEC Report for the 8th of January 2016. I'm Elisa Barwick, and joining me today is CEC leader Craig Isherwood. Welcome to the first show for 2016, Craig.
Yeah, thanks Elisa, it's good to be back.
Yes, and in today's show, 2016 opens with financial bang and Depositor Bailin takes effect across EU, well underway in Australia. So firstly, 2016 opens with financial bang. We've seen this year begin with quite extraordinary market turmoil throughout this week. China's markets this week alone have closed twice because the automatic circuit breakers cut in after the market crash reached between 5 to 7%. There are warnings of a new crash everywhere. For example, the UK Chancellor George Osborne has warned of a dangerous cocktail of economic crisis. And also Le Parisien has warned of the spectre of a new crash, citing an economist saying, quote, "The speculative bubble has not stopped inflating and it will explode sooner or later."
Yeah, Le Parisien, at least it's not some small newspaper, this is a major paper in Paris and has a circulation 4 times the size of the Australian, Murdoch's publication here in Australia. So this is a significant warning that's come out in mainstream press.
Yeah, this was an economist they quoted saying it is a Damocles sword that can strike us starting in 2016. So we're going to quickly take a look at the build-up of various factors creating for a perfect storm sometime over the coming period. So firstly, you have hedge funds and mutual funds. Nevsky Capital Hedge Fund, which is based in London, is a large hedge fund, has been the first to shut down for 2016. But in the last months of 2015, there was a rush of hedge fund collapses, which included, just to name a few, Lion Eye Capital Management, Fortress Investment Group, Blue Crest Capital Management, Third Avenue Capital and Stone Lion Capital. But there's also many, many more that are basically on life support and are juggling in order to avoid imminent bankruptcy. Junk bonds. Now there's been a spike in defaults and bankruptcies of junk bond debtors, and there have been warnings that this will turn into a wave in January, February. Then you have the oil and gas sector, where major Wall Street banks are exposed to the tune of $5 trillion in combined junk bonds and loans to the shale oil and gas sector, which are at risk as prices collapse in that sector. Of course, a lot of the positions that were taken by these entities were based on $85 per barrel of oil or more. Now it's below $34 per barrel. And this $5 trillion, by the way, is much worse than the subprime mortgage bubble in 2008, which was around about the $1 trillion mark. So we're looking at a much bigger risk here. You have 25% of junk bonds that are linked to the energy sector, which are listed as distressed.
And you haven't even mentioned the derivatives that are tied to the oil and shale business, particularly the oil.
Exactly,
industry.
That's a whole nother monster. But even giant companies like Glencore and Anglo American are now rated at a more than 50% chance of default, given what's going on in the resources sector. Now you also have the risk of sovereign defaults, and you have Puerto Rico, for example, where they owed $1 billion on their debt payments on the 4th of January, and that's part of their $72 billion debt. Now they did what Greece did, and they stole funds from other government agencies in order to pay part of that on the 4th of January, but they did default on nearly $39 million. You have similar situations across Europe, in particular Spain, Portugal and Italy are all boiling over. European banks have slashed 130,000 jobs in the last 6 months of last year to try to cover up and make up for losses. And now in the United States, of course, remember late last year they did for the first time put up the interest rates in a long while, and UBS Bank has now just called in just the last day for the US Federal Reserve to reverse itself on that decision and return to 0 interest rates and start quantitative easing 4. Now, Craig, we always have said all the way along, and people who've watched this show for a while will know that that the GFC never ended in 2008. It was not over. In fact, that was just the beginning. And given all the attempts to prop it up, we are now facing a much worse scenario.
Well, the worst scenario, Elisa, which we'll go into in the next segment, is the fact is the intention of the banks and the governments to steal people's deposits. It's called bail-in. And since 2008, 2009, we've been warning that the only solution to dealing with the massive amount of debt in the system through derivatives in particular, and we're talking about a $2 quadrillion bubble in debt and derivatives and so forth that's sitting on top of the world's productive economies, and that has to be basically written off. The only solution for this is what we've been campaigning on, and that's called Glass-Steagall, which is the lawful and legal separation of the commercial banks that we need for an economy from the investment in merchant banking speculative side, to literally separate the two. Break up the big banks, like the so-called GSIFIs, the globally systemically important banks that are too big to fail. You have to break them up. You have to separate them out of the existing banking system. And that's what we call for Glass-Steagall. And we put this magazine out in 2013 initially, calling for Glass-Steagall now. And this is what's actually required right now. If we go into a system of uncontrolled collapse, which is what we're starting to see through these warning signs, a bit like the rumbling of a volcano actually, and people say, well, this is pretty serious rumblings. I mean, look what's already happening. Well, we haven't seen anything yet in terms of what's about to happen. So the bail-in, the stealing of people's deposits, which is already taking place, is happening now. The solution is Glass-Steagall, and there's a global movement for the Glass-Steagall, Elisa. There's many former high-level bankers that made decisions to get rid of Glass-Steagall, back in 1999, have come back and said, look, it was a mistake. You've got leading candidates in the Democratic side of the current presidential race, like O'Malley, for example, Martin O'Malley, calling for the reintroduction of Glass-Steagall. And of course Hillary Clinton is saying, no, we can't have that because it's too hard to manage, and all sorts of excuses. But she's basically apologising for the big banks. So there's a massive fight taking place around Glass-Steagall at the presidential level right now.
And in the United Kingdom as well, at the highest levels.
That's right, in the United Kingdom as well. So you've got this, and people need to get onto our website, read our media releases to be able to find and follow what is taking place with this particular fight.
Yeah, so we'll take a quick break there, but we'll continue talking about this right after this break. Welcome back to the CEC Report. We're now discussing Depositor Bailin takes effect across EU, well underway in Australia. Now, you mentioned a new policy of bail-in, Craig, which we've been discussing for some years on this show. And we had a very big campaign in 2013 to stop bail-in coming in as legislation in Australia, and that sparked off of an actual bail-in, the first ever in Cyprus in March of that year. Can you explain to viewers what this was all about?
Well, this is a real shock for the system because it's the first time it ever happened, but you had a situation where Cyprus couldn't pay its debts. So it actually froze its banking system and created two banks, a good bank and a bad bank, and literally shifted the assets of the bad bank over to the good bank, and then froze all the depositors and stole the depositors' money up anything above €100,000
to prop up the banks.
To prop up the banks. So you had literally people lost their savings, the entire system, the entire economy was frozen because it was not possible to have any commerce or whatever, because literally the money that people had in their bank accounts as deposits was taken. Now this is what bail-in is. It's bailing is trying to reduce the liabilities of the system by stealing people's deposits. And this is now actually the policy for Europe. It came in to the European Union on the 1st of January, and it's also being actively sought in places like Italy and so forth. So that's what bail-in is. It's as you say, it's a campaign that we began campaigning on very strongly in March of 2013 because we immediately saw that this was going to be the mode of operation for the global financial oligarchy in order to try and keep propping up their system. Steal people's hard-earned money that's put into the banking system.
And we found documentation, and it was very well hidden. There were only traces of it to be seen, but during 2013, as we investigated this, we saw that there were references in Financial Stability Board documents. That's a board that's run by the Bank for International Settlements that has been the ones pushing for this bail-in policy. And also Treasury, Australian Government Treasury documents, APRA documents, on IMF documents, and we've published all of that evidence, which you can find in that magazine we've referenced, that they all referred to bail-in being in train in Australia. So we weren't coming at this from the standpoint of it might happen here. We knew it was being planned here, and that's become a lot clearer since then, which we'll talk about in the next segment. But we ran, for example, an ad where because we mobilised communities across the country, 450 local government officials, political party leaders, trade unionists, etc. across the country signed onto this saying don't seize our bank accounts, pass Glass-Steagall, which was the alternative that we put on the table. And we met with, hundreds of politicians and other leaders, high-level government officials even, who mostly denied that this was happening, which is a complete lie. Now, I will add to this that the G20 meeting, which of course Australia participated in, which was held in mid-November last year in Antalya, Turkey, did finalise a bail-in agreement for too big to fail banks, where they have to put aside 16% of their risk-weighted assets by 2019. So that's been agreed to by all G20 member nations, which includes Australia, and the Financial Stability Board basically said what that means is that it is expected that all member nations will put that into effect now. But you also mentioned that there have been bail-ins just in the recent period, and Italy was one of those where 4 small banks collapsed and were bailed in, and somewhere from 10 to 100,000 shareholders and junior bondholders lost money. There were 100,000 people exposed in these subordinated bonds, and they were encouraged to invest in these bonds to get higher returns. So their bankers were saying, why have you got this money sitting there in a deposit account? Put it into these bonds.
And just listen, can I just make the point here is that, people say, that's in Italy, that's not happening in Australia. Well, it is happening in Australia. I mean, the government has established these things called bail-inable bonds. They're not things that you can go and just down the street and buy over the counter. These are bonds that are sold by the banks to superannuation companies, right, who've got large amounts of money. We know there's about $2 trillion in funds. Now, these bail-inable bonds are sold at higher rates of return, but in the case of a bank getting into problems here, they're the first thing to go.
Yeah.
So here you have a de facto, it's not people going over the counter buying these things as in the case of Italy, but through their superannuation funds, these bonds are being bought, and people wouldn't have a clue how many of these bonds are being bought by the superannuation funds.
Exactly, and there was a case in Italy of a pensioner, Luigino D'Angelo, who actually committed suicide on the 28th of November after he lost $110,000 that he had invested in such bonds in one of these 4 banks that collapsed in November. And he'd actually written a letter to the bank prior to his death accusing them of stealing his life savings, all the while reassuring him that these bonds were safe. You also had the case in Portugal where at the end of the year, Novo Banco, and that bank was actually the result of what you described earlier of a good bank and a bad bank being set up out of the Banco Espírito Santo, which happened in 2014. But that good remains of the bank, Novo Banco, was running into trouble, and 12 billion euros was expropriated from senior bondholders in that case. The remaining bondholders ran on the bank, and the bond values fell from 94 cents on the dollar to 14 cents by that afternoon.
What we're noticing, Elisa, from what we're looking at with European bail-in operations, is that there's no laws. They're not following any particular laws. They're just basically doing what they please, patching things up afterwards, which is a real danger.
And in all of these cases, like Portugal and Italy, even Cyprus, it's been admitted by many people that they've just made it up as they've gone along because it really isn't enshrined. But that being said, on the 1st of January this year, a European-wide bail-in regulation did come into effect, which is meant to standardise it all and create a single rule book for bail-in. This is called the Bank Recovery and Resolution Directive, or the BRRD. Now, the first thing you need to know about this, which is very important, is that unlike the G20 we referenced before, which has agreed to bail-in, Those bail-in procedures adopted by the G20 apply only to the globally systemically important banks, the G-SIBs. This European BRRD refers to all EU banks. So it refers to small banks, big banks, all the banks. So this is a very important step up. Now, in the case of Italy and the bail-ins that they just conducted, the Italian regulator, Carmelo Barbagallo, actually said that it would have been worse. Like the Italian government preempted these rules coming in to save, some people greater losses. Barbagallo said that 1 million savers would have been affected under the new rules, and he went on to say that the bail-in can exacerbate rather than alleviate the risk of systemic instability caused by the crisis of individual banks. This was at a parliamentary hearing on the 9th of December, because there's an investigation into how this was conducted with these 4 banks in Italy. Bloomberg columnist Mark Gilbert also warned that the bail-in regime will kill a crucial source for the entire financial system as people stop lending to the banks. And former Italian government minister and former head of the Deposit Guarantee Fund, Paolo Savona, said that all of this bail-in procedure is at the discretion of men and not of the law. The definition, he said, of guaranteed deposit is imprecise and open to manipulations and to fraud, because they're meant to guarantee 100,000. Only deposits above 100,000 are meant to be confiscated. But the BRRD documents are extremely vague, and one area where they're the most vague and provide the most leeway is when it comes to derivatives, because it says that derivatives can be excluded, and in that case, authorities will not be obliged to terminate or close out derivatives contracts. Now, Craig, isn't it the case that all of this bail-in and stealing of shares and bonds and deposits is actually to bail out the derivatives factor?
Well, that's where the problem comes in and why we need Glass-Steagall. This is what we're talking about with the casino economy, with the speculation of the merchant banks. I mean, in Australia, we have an enormous amount of derivatives, something in the over $30 trillion of derivatives, notional capital value of derivatives. Now, these things are, no one knows where the counterparties are. It's like going into a casino, literally. That's how they're being compared. So what you have is a legitimate banking system economy based upon gambling. Now, this is where the problem's coming in. But it's so large that unless you put this through an organised bankruptcy reorganisation through Glass-Steagall, it's going to bring the system down. But the current authorities like the EU Commission and others, IMF and others, saying you can't touch this because if you start touching this, the whole system's going to come down. We're going to lose our power, we're going to lose the system.
Yeah, once upon a time banks would just be allowed to crash. Yes, some people would lose money, but on this scale, like those 4 Italian banks are still open, they're still functioning, but people lost all their money because they cannot afford to let the bank crash because it could spark the collapse of the entire global framework under the derivatives.
And that's the economy, which is supposed to support people, right?
Exactly.
So that's what happened in Cyprus. The entire economy shut down. They couldn't trade. People started to die. And same in Greece. The entire economy started to collapse. People started to die because healthcare and the necessary aspects of the economy to support people was taken away. And this is what this leads to, Elisa.
Now, after the break, we're going to talk specifically about how bail-in exists, really by stealth now in Australia. Welcome back to the CEC Report. We're discussing Depositor Bailin takes effect across EU, well underway in Australia. Now, regarding bail-in in Australia, there's no evidence of actual legislation which they would have to pass by the Parliament, and therefore it would become known and the population would oppose it. So they've been quite tricky about how this is conducted. And I'll reference, and we'll talk about this more in coming weeks as we look more into it, but there was an article in the Australian Financial Review by Christopher Joy on the 20th of December last year. And he specifies that the government has told APRA, the regulatory agency, to make sure that we are in line with emerging international practice. And we've just talked about what the emerging international practice is, it's bail-in. Now, he shows how this can be done without specific bail-in legislation. And I just want to quote a section of this here. He says, Australia already has a de facto bail-in regime under the Banking Act and Business Transfer and Group Restructure Act. says Dale Rayner, a partner with Norton Rose Fulbright. These acts enable the compulsory transfer of assets out of a bank subject to a requirement the transfers be made on just terms, Rayner says. APRA evidently agrees, informing the FSI that it has compulsory transfer of business powers which could be used to achieve a similar economic effect to a bail-in. This power could be used to transfer a failing bank's assets to another entity, leaving behind capital instruments and certain unsecured liabilities to absorb losses, APRA says. Andrew Jinks, a Clayton Utz partner, concurs, concluding, the Banking Act empowers APRA to sell assets on any terms it deems appropriate and leave unsecured creditors like senior bondholders with whatever proceeds are paid for the assets. If the proceeds are not sufficient to repay the bonds, then investors suffer losses, Jinks says. Now, he goes on to discuss whether there would be any legal impediment to carrying this out, and there doesn't appear to be, at least from the people that he interviewed. So, Craig, what can be done about this?
Well, Lisa, just to let me back up what's being said there by Christopher Joy. The fact is that APRA does have enormous powers. It can create the good banks and the bad banks, like we've seen done in other parts of the world. It's charged with two things: to maintain what's called depositor preference and to maintain financial stability of the system. Now, depositor preference is a very important thing. It means that if there has to be a resolution of a bank, the depositor's funds are the last thing to be looked at. But what people don't realise is that it's a preference. It doesn't mean that APRA is guaranteeing their deposits. There is a depositor guarantee up to $250,000 in this country, but even that can't work if you're talking about one of the big four banks. And that's been acknowledged by the Financial Stability Board and the IMF overseas, that our bank guarantee system can't work.
So we simply wouldn't have the money to cover that?
That's correct. I mean, the amount of deposits that would be insured, so-called, or covered by is far, far greater than the appropriations made of the $20 billion. So what you've got a lot of smoke and mirrors here, which is typical of the banking system.
Yep.
And people think, oh, my savings are safe, or my deposits are safe. Well, they're actually not. They're not. We have a de facto bail-in regime in this country by virtue of what APRA can do, and it's so murky, right? And it's so unclear because people are assuming that the intention of APRA and these institutions is to protect them, when it's not. It's to protect the system. It's to protect the G-SIFIs, the globally systemic important banks, right? And wherever you look at the European example, they're not worried about the individuals, as like this person that committed suicide in Italy and hundreds of others like him. They're concerned about the system. So people can be expected to be thrown overboard, lose their deposits, like in a flash in the pan, if there is a major event in this country. And that's why we need to have Glass-Steagall. We need to have a system where you have a thorough guarantee of people's deposits, a separation of the commercial banking system is protected through regulation, and legislation to protect that regulation, like was done by Curtin and Chifley during the war, where they actually regulated the banks and made the banks subservient to government direction, and get rid of the speculative merchant investment bankings, ditch them overboard, or as LaRouche says, get rid of Wall Street. And that's what we've got to do, and it's becoming exceptionally urgent. And I think people really need to join our mobilisation to do this.
If this is all new to you, call in and we'll send you a copy of this, which will lay out the entire issue. Now, thanks for tuning in to the CEC Report. That's all we've got time for this week. Thanks, Craig.
Thank you.
And join us again next week.